Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're once again exploring the UBS Global Real Estate Bubble Index. As you'll likely recall from previous iterations, the 2025 edition of the GREBI features deep insights into current global and regional real estate trends. The index analyses residential property prices in 21 major cities around the world. This year's report includes city spotlights on the likes of Miami, Tokyo, Zurich, Dubai, London and Frankfurt. Amongst the standout trends and observations, we have Miami at the top of the list for so-called bubble risk, insights into regulation as trigger for price corrections, and observations that in 19 of 21 markets, housing construction is trending down. Well, to discuss those and more of this year's findings, we're once again fortunate to be joined by two of the people behind the index. Matthias Holzhey, real estate economist and analyst in UBS Global Wealth Management and lead author, and Maciej Skoczek, real estate analyst at UBS Global Wealth Management CIO and another author of this study. Matthias, Maciej, a pleasure to welcome you both back to the show. Let me start with you, Matthias. What do you and your colleagues set out to do with the GREBI each year, and why is it so important?
Okay, let me try to summarize that. I mean, what we're doing is we're trying to quantify bubble risk, okay? And a bubble is in a sense a mispricing of an asset. So basically, we try to quantify if house prices are too high in relation to, let's say, market fundamentals. And maybe the question now, how do we do that? Well, we look at historical episodes of bubbles. We try to identify recurring patterns. And based on that, we come up with an analysis, which we apply then to, currently it's our 21 cities around the world. So we use for all the cities the same method. So it's comparable basically across the continents. And yeah, I think that's it.
No, excellent. And just, I guess, maybe from both of you, just in terms of what the prevailing picture themes are that speak to this piece. Obviously, we'll get into the market specifics in a second on a case-by-case basis. But, you know, there are other trends, right, that are important. So whether that is rising public debt, the sorts of quandaries that policymakers face when trying to deal with that, inflationary pressures. What are the things specific to this year, or actually that are perennially the case, which also kind of underpin this area when you look at it? I don't know, maybe you could both weigh in on that?
Well, I think there are two things which come to mind. And the first thing is that we see that global house prices are still stagnating. So the average home worldwide has not gained any value in the last quarters. Okay, and the reason for that is that prevailing interest rates are still too high. House prices are still not compatible with the interest rate level. This holds especially in all areas which are somehow linked to the US dollar. Okay, I think that's one thing. And the other thing is a major issue is regulation, which is determining also or impacting house prices. This is something which we see across more and more cities in Canada, in Europe, everywhere we have more and more cities where politicians try to protect the inhabitants from the affordability issue, and there are always three options they can try. Either they focusing on foreigners, they try to stop foreign demand, it's the first thing, or they try to limit rental growth. So they introduce some sort of rental breaks or try to interfere in that market, or they try to improve supply. So I think that's the playing field where we are in.
Yeah, absolutely. Well, look, let's dive in a bit more detail then and look at some of the headlines. And I think Miami, I'm right in saying, still showing the highest bubble risk by your metrics among the cities in this study. But there's also high risk in some other markets, many of which are not by any means strangers to this list, the likes of Tokyo, Zurich, and elevated risk in other places. Give us a bit of a sketch. I mean, Matthias, maybe if I come to you first of all, where the perceived bubble risk is greatest.
I mean, the top of the ranking. I mean, this is basically unchanged for last year. Okay. We're still having Miami, Tokyo, and Zurich. And what may be important here is that risk has been actually declining, okay, in both Tokyo and Miami. Okay, and in Zurich, it's still increasing. But I think the key differentiator here is, I mean, for Tokyo and Zurich, these are both cities which have a strong economy and where interest rates are actually too low. Okay, interest rates are too low for these cities, and that's why we're seeing this exuberance on markets. And I mean, Miami has just been one of the hottest markets with a lot of foreign demand and lots of speculation, but also strong fundamentals, but which have gone too far.
And just tell us, with a market like Miami, as you said, it's been up there for a while. It's interesting. And whilst we've seen the home price growth slowing, nevertheless, there's still strong demand, isn't there, internationally, from LATAM in particular. There's unique challenges and opportunities in each of these markets, aren't there? You have to look at each one very carefully on its own merits, right?
Yes, exactly. I mean, there is no like one tip where you should invest, where you should go. So every city has its specifics. For example, when we look at Miami, which is on top of our index, then we see that over the last 15 years, Miami has posted the strongest inflation-adjusted housing price growth among all the cities that we analyze. I mean, there's no wonder that they are on the top of the list. And there was also a very strong demand, coming from the northern states during the pandemics because of home office, because of favorable taxation, nice climate. So, yeah, that has elevated prices in Miami. For example, drivers in Tokyo are completely different. In Zurich, they are also slightly different. As Matthias already mentioned, the very strong economies in those two cities. So you really need to look at single cities, not at the group of them.
Yeah, and I just want to pick up, I think you mentioned regulation and regulatory concerns earlier, which I think is really interesting, because it's funny, now we've been looking at the Grebi over such a long time frame. Some of these newer rules in certain markets, I'm thinking, sought after markets such as, we had the likes of Vancouver, Sydney, Paris, right here in London where I'm sitting, who have maybe dropped down the list a little bit now. And I guess that is certainly in part related to these tougher regulatory rules, right? That might be taxes or outright bans. Is that a trend, though, that does seem to be making itself felt pretty much across the board?
Yes, and I think it's the interesting part here is that the regulation always comes too late. Okay, you can take Canada as an example. Okay, now they have a foreign buyer ban. But the problem is now they have not enough capital. So basically they not enough capital for investment. So basically now they are already start to feel counter pressure here because someone needs to build the new apartments. And the same, for example, we can take now Madrid, where they're just heating up the market by letting in a lot of foreigners, by selling visas for real estate, basically, something which they have now to stop. Okay. But the most shocking example of regulation here, I would say, is Amsterdam. Okay, maybe that's something which I think is really intriguing. How far you can go wrong as politicians. Basically, their housing is not an investment anymore. Okay, so everyone has to sell their apartments essentially, their rental apartments, because it's not allowed to rise rents in this manner. You're so sharply regulated. Buy-to-let is not allowed anymore. You cannot put things on Airbnb and so on. Okay, so you're really So there, basically, the market has really been destroyed.
I mean, the takeaway from this regulation discussion is just the regulation can really be a trigger for a price correction. And we saw it in Vancouver, we saw it in Toronto, in London, in Hong Kong, with additional stamp duties. And there are new markets coming in, like we have a new regulation in Sydney, when they also introduced foyer buyers ban recently, and also introduced new planning regulation to increase supply. Let's see how it's going to change the market. We also have a vote here in Zurich, where we are sitting, on rent controls. There will be a public vote in November, and this could really disrupt the market.
One of the reasons why these regulatory risks are felt ever more is presumably because, in certain circumstances, they're being introduced to try to aid affordability, right? Which is a problem. There's this unmooring, isn't there, between incomes and the cost of property. Are we seeing that the affordability picture is getting any better? I think Hong Kong is the least affordable city in the study, but are these regulatory changes beginning to chip away at that affordability problem?
No, not at all. I mean, what has helped inflation has helped to some degree, okay, because in many cities we have seen house prices can actually not keep up with inflation, while incomes at least manage to even to grow in real terms, especially in Europe. But I mean, also in Hong Kong, for example, where affordability is still very bad, but has significantly improved compared to a couple of years ago. So I mean, the market, in a sense, regulates themselves to some degree. But I mean, rent controls never actually help. The only thing would help is an increase in supply here. But what we're seeing is in many, basically the pattern is that in all the big capitals, okay, there are Paris and London, Tokyo, housing remains totally unaffordable for a majority of people. But also an important point is, I think that the absolute, not the most important thing here. I think what really counts is the change, okay, because people remember the good old times, and so if you have a significant worsening, then there's a lot of pressure to act, but that's rarely been successful.
We have our indicator that's price to income in our study. And what we also look at is, how the financially affordable living space has changed over the last years. And we see that currently what a skilled service worker can buy is roughly 30% smaller than it was in 2021. So you can imagine, like, affordability hasn't improved since then. It's still in many city centers, in many capitals, housing is unaffordable for many.
Yeah, well, against that backdrop then, if we zoom out a little bit, what about if we say, what do investors need to take away from this? If we look at, say, real estate, presumably this backdrop means that real estate, if we're generalizing, stands to benefit broadly because you've got higher inflation, which can aid homeowners if it erodes fixed rate mortgage debt, I guess. And you've got people seeking assets with positive returns, right? So is this potentially, is that the sort of the good news angle here, guys?
Yeah, I think that's one of the positives. In the short term, we will see lower interest rates likely, not like low nominal interest rates, especially in US dollar term. And in the long run, government finances are just not sustainable. So they will have to pursue an inflationary agenda, and they will have to do something about interest rates. And I think that's something which will support prices for real estate. And then there's also the demographic point of view.
Yes, exactly. I just wanted to add it. Our society globally is getting older. And with society getting older, cities are actually favorable as, places to live. You have better infrastructure, you have public transportations, you have hospitals. So people would try to live in the cities. So that's a good news for our urban housing. A great example is Japan. Over the last 5 years, the population in Japan dropped by more than 10%. Cumulatively. On the contrary, Tokyo is up 10%. So you can see that the urban housing really is demanded, and that will be also demanded in the future. And I believe that's a good news for investors.
What's also striking a study is the difference maybe in yields or in the price to rent ratio. And I think that, in Zurich, for example, okay, you need to wait 43 years of rent. You need 43 years of rent basically to get your purchase price back. And in other very hot cities, let's say in Dubai, Miami, you just need to wait for 15 years. Okay, and I think that just shows you that if you invest in real estate, or if you want to purchase multiple, let's say, houses around the world, then I think this diversification is really important, and it really comes down also to individual, let's say, the individual risk capacity.
Yeah, also a very interesting point, I believe, is also coming from the construction side. It's also important for the investors. So what we see is that housing is really scarce. And the building permits right now, they're really low in most of the cities that we analyze. We have only 2 cities where the building permits over the last year were accelerating when you compare it over to the last 5 years, for example. In all our cities, so in 19 cities out of 21, the housing construction is rather trending down, meaning if you're an owner and you want to rent it out, for example, then you may see very nice returns.
Matthias Holzhey and Maciej Skoczek. And that brings us to the end of this edition of the show here on Monocle Radio. There's more, of course, at monocle.com, or you can follow the show wherever you get your podcasts. Do discover more in the meantime and find out how UBS can help you at ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.